Welcome back to part 3 of Accounting Basics. We are now going to take our T accounts and turn them into financial statements. We're going to take the T account balances for every T account and we're going to convert those into our balance sheet. We're going to take the P&L T account and turn that into the income statement. Finally, we're going to take the cash T account and turn it into the cash flow statement. So here are our T accounts. Now, this is our asset T accounts, and we have several different items. Cash, we have accounts receivable, prepaid expenses, inventory, equipment, and accumulated depreciation. I'm going to create my balance sheet, and there's going to be line items for each of these T accounts. And next to those line items, I'm going to have the balances. Here are the balances. We can find them here. For the liabilities T accounts, we're going to do the same thing. We're going to have line items for accounts payable, long-term debt, deferred revenue, accrued rent, and for each of those, we're going to have the balances. This is not very hard. Owner's equity, we have to do something first. So we're going to have only two accounts. We're going to have capital and retained earnings. The P&L account is a temporary account. We're going to use it to create our income statement, but we're going to cross it out. If I could, I'd cross it out. And I'm going to take this balance and I'm going to put it here. This is where we have a profit. So I'm going to put it here. Okay, so I'm no longer looking at the P&L for the balances. I will look at it when I do my income statement. The balance, I'm going to look here. This is the idea. Remember, we said that the profits belong to the owners. This is a temporary account. It belongs here. So capital is what the owners invest into the company. The retained earnings are the profits that the company keeps. That belongs to the owners. It is represented here in their owner's account. So let's look at our balance sheet and see what I've done. All right, so now this should all work together. Let's see if it balances. Remember, the formula is assets minus liabilities equals owner's equity. That's assets minus liabilities should equals owner's equity, and it does, but usually a balance sheet presents it this way. Total liabilities plus owner's equity is $136,100. That should equal assets, $136,100. Now, you see, these are all of our T accounts. We had a cash T account, accounts receivable T account, inventory T account, and a prepaid expenses, equipment, less accumulated depreciation. This number is all of these added together minus this will equal our total assets. Same thing with liabilities. We have accounts payable, deferred revenue, accrued rent, long-term debt. These are the balances, and that equals $21,400. Capital account, we remember our investors, Bob and Mary, invested $100,000, $50,000 each. The company made a profit last year of $14,700. We keep that profit. That belongs to the owners. All right, so that's the balance sheet. Really pretty easy once you've done the accounting, once you've done the T accounts. Let's look at the income statement. This is our income statement. Now, remember, we said this comes directly from the P&L account. So let's go look at the P&L account. P&L account, I have revenue on this side. Then I have my cost of goods sold here. And then I have separate expenses for utilities, wages, rent, interest, depreciation, and insurance, with a profit of sales, revenue, minus expenses equals $14,700. Let's go look at the income statement. Here is the income statement. The income statement, we have revenue of $107,100. And where did I get that? Well, let's just go back to our owner's equity account. That's all of this added up together. All right, back to the income statement. I have costs of goods sold of $61,200. Let's go back to the P&L account. These three items added together equal $61,200. That's the cost of goods sold, the cost of us acquiring the widgets that we actually sold during the year. All right, and that gives us a gross profit. Revenue minus cost of goods equals gross profit. Then I have various different expenses, and these come right out of the P&L statement, the P&LT account, and that gives us a net profit of $14,700. Let's now go to the cash flow statement. Remember when we booked a cash transaction, we asked whether it was cash from operating activities, whether it was cash from investing activities, or whether it was cash from financing activities, whether it was an operating cash flow, an investing cash flow, or a financing cash flow. So for our operations, we had $87,500 received from our customers, cash received from operations. Cash we used for operations, either paying our suppliers for widgets or paying expenses in cash, were $88,200. And you can see our cash flow from operations was a negative. Now, where did I get these numbers? Once again, I got them from my asset T accounts cash. Here's the operations cash from operations activities, right? And here is the cash used in operating activities. All right, let's go back to the cash flow statement. Now, then we had some investing activities. So we didn't get any cash from investing activities, but we did spend cash on investing. Do you remember what we did? The $25,000, we purchased a truck. So there is the cash from investing activities, and that was the purchase of the truck right here. Cash flow going out for our investing activities, which means we have negative cash flow for investing activities, which is pretty common. You'd expect some positive cash flow from operating activities. That would be good. Investing activities, usually you're going to have negative cash flow. Now, cash from financing activities, how did our company raise capital? Well, you see we have $110,000 from financing. And then cash used in financing is $1,000. Where did this $110,000 come from? Well, let's go check our asset T account. This is our cash T account. And here we have financing. This is where the investors, Bob and Mary, each invested $50,000 into the company. For Bob and Mary, that's an investment. For the company, that's financing, raising capital. And then we borrowed $10,000. The company borrowed $10,000 from a bank, and that's how we raised $10,000. So that's $110,000 cash flow from financing activities in. That's cash in. Here's cash out. Here's our financing cash out. Do you remember what that is? Well, we paid down $1,000 of the principal on that loan in cash. So that is cash out for financing activities. And that is there. So our total cash from financing activities for the year was $109,000. Now, this was the company's first year in existence, so it began the year with $0 in cash. Then it had negative cash flow of $700 from operating activities, negative cash flow from investing activities, but positive cash flow from financing activities, which gives us a positive cash flow for the year, or cash at the end of the period, of $83,300. And that is how you create financial statements.